welcome to June's Power Hour, live from my kitchen. If you hear any funny noises, I've got a 12-week-old Labrador puppy that's asleep in a basket, but he may wake up. So if you hear any squeaking, it's the dog needing to go outside. Okay, I think we'll crack on now. For those of you that don't know, I'm Joanna Oliver. I'm the Director of Global Programmes for the CEA. I've been working for the CEA, since 1995, which I think makes that 27 years. So it's really nice that we're still running these webinars. We weren't quite sure whether we would keep them up after COVID, but I think it's a really good way of keeping in touch in between any live events. I'll quickly run through the housekeeping. Webinar is, as always, run in accordance with the CEA corporate compliance rules, and you can find a copy of those on our website. The webinar is being recorded and will be available with the slides on the CEA website once we've got it downloaded, and we will also send a link to that to everybody who's registered today. Please stay on mute. We know it's a lunchtime event and we hope you're all enjoying your sandwiches and crisps while you're watching it, but we don't necessarily need to hear you enjoying them. If you'd like to ask a question, please use the Zoom chat box, and we can run through those at the end of Seamus's presentation. Please turn your video off just to conserve bandwidth. I'm really pleased that we've actually got some bandwidth because I live in a little village and somebody drove a tractor into the fibre optic box about 10 days ago, and we only got the broadband back yesterday, so that was bit of relief, and we're trying our best to make all the tech work, so if anything goes wrong, bear with us. So I'd like to introduce our speaker today, Seamus Nevin, the Chief Economist at Make UK. Seamus made a presentation to the CEA Management Council a month or two ago and made the mistake of being so good that they've asked him to come back. CEA work quite closely with Make UK as one of the contributing trade associations. I attend the External Affairs and the Manufacturing Alliance meetings, and I find them enormously useful. It's great to be able to feed into a large association representing all kinds of manufacturers, from big OEMs right down the supply chain to the SMEs. I've whittled on enough now, so I am going to stop sharing my screen and pass over to Seamus.
Lovely. Thanks, Joanna. I'm going to share my screen now with everybody. Hopefully this works. Okay, so hi everybody. It's lovely to join you. I'm going to give you some of the latest insights that we have about the state of the UK economy and the manufacturing sector in particular from recent work that we've been doing here at Make UK. It's going to be a broad overview concerning the whole of the UK manufacturing sector, but where possible, and I will do a little bit of deep diving into more construction and equipment focused aspects. But just to start you off, this is a bit of an horizon scan. So as you can see, the manufacturing sector and the wider UK economy are grappling with several significant challenges at the moment. These include, but are not limited to, all of the things you can see on your screens, from spiraling energy costs, including wholesale gas prices and the effect that that has on energy costs more broadly, rising inflation for input components and consumer goods, the burden on cash and the squeeze that that's causing for firms, as well as the debt implications, particularly as COVID-19 loan repayments come due for smaller firms and those that are a bit more cash strapped, raising the risk of insolvencies. The ongoing direct and indirect impact of Russia's invasion of Ukraine, which has had a hugely disruptive effect on global supply chains. The resurgence of COVID-19 and lockdowns in China, which is also adding to disruptions in global trade. Growing interest rates, of course. The scarcity of labour growing and a pushing demand for increased wages in firms. and then political and regulatory uncertainty, all to do with trade tensions and political and diplomatic tensions between Her Majesty's government and the EU, and the potential risk that that has for political instability. We might be facing an election if there were to be a leadership change potentially, but more directly around the trade relations that we have, not only with the EU itself, but with other partners of the EU, notably the United States, which has said that they want the United Kingdom government to uphold and maintain all aspects of the Northern Ireland Protocol, which is currently causing a lot of tensions within government here. So moving on to a more specific overview of the economy, these are kind of the headline figures, or the headline points that I'm going to be talking about as I progress in the discussion. So firstly, to say that our latest data shows that output and orders in manufacturing are still positive, but are exhibiting a continued decline, and new order growth has slowed significantly. And that's both for UK domestic orders from within the UK economy, and also for export orders as well. Price growth, or rather costs really, has been record breaking recently, and that has continued. But now we're really beginning to see a pinch or a squeeze more assertively in terms of profit margins across the sector. Employment and investment intentions have taken a hit as a result of all of this. And as a result of that, we are expecting a slowdown in the economy overall, albeit our survey suggests that member firms across the manufacturing sector seem to be relatively optimistic about their own individual firms. Nevertheless, we expect a slowdown in the manufacturing sector economic forecast for this year, which we have revised down to about 2.3% growth for this year, and 1.7% for next year. And for the wider UK economy as a whole, including services and everything else, we now expect a slightly lower growth rate of about 3.6% this year, slowing down quite drastically to 1.4% next year. So not exactly the most optimistic start to my presentation, but let's get into a bit more detail. As you can see from this graph, the lockdown lag effect means that orders are still outstripping output. So total order balance for the latest quarter of research indicates a much sharper slowdown in growth of new work. The latest balance of 20% is less than half that level seen in the previous quarter, so it shows a very sharp slowdown in recent months, suggesting that the demand boom that we saw as the economy started to open up again post-lockdowns may finally be coming to an end. The gap between the balance of output and orders, which is the difference between the red and the orange bars on the chart that you can see, has also shortened in absolute terms, which may be a sign that the supply chain challenges are easing. However, total orders remain twice the size of output levels, indicating substantial delivery challenges persist. So essentially, lots of firms finding it very difficult to get component parts to finish the products that they're making. And as a result, while they might have significant order books, they're not necessarily able to deliver the goods in the timely manner that they would normally do so. So Make UK members have consistently highlighted the difficulties they're facing around accessing component parts and raw materials, which is making it more difficult to meet customer demands. On the next slide, you'll see that export orders are falling and UK orders are still strong, relatively speaking, but also in decline. So UK orders have continued to outperform export orders, reporting a balance of about 16% this quarter. However, the rate of growth for the domestic market has approximately halved between the first and second quarters of this year, highlighting a significant impact that recent events, including supply chain issues, have had on UK markets. That said, it is a positive balance of 16, which still indicates growth at a level that far outweighs the growth seen in the export markets, which is just 4%. This marks the 7th quarter in a row for our survey that the domestic market has technically expanded in terms of orders, despite the obvious slowdown in the rate of growth. However, as industry continues to slow and businesses face increasing costs, the risk of a decline in the domestic market is also growing. The sharp slowdown seen in new export orders is not surprising, given most recent shocks to supplies have been both external and international in origin. The two main causes of this are the Russia-Ukraine conflict and the resurgence of COVID-19 infections in China, which has led the Chinese government, which is still pursuing a zero COVID policy, to initiate lockdowns, particularly in key trade ports. In addition, the UK continues to face many unique export challenges brought about by the change to our trading relationship with the EU. And from the perspective of EU manufacturers, this change has made the UK a less attractive market to buy goods from. It's become more difficult for them to access the UK market. The concerns for manufacturers is now whether the tensions around the Northern Ireland Protocol will lead to further trade difficulties with our EU market and also potentially with the United States as well. So that's a big worry. But regardless of the outcome, the mere threat of further trade difficulties with our biggest trade market is impacting UK businesses, as foreign customers perceive the UK as a less stable place to do business and are therefore less willing to negotiate and agree new deals. So not exactly a great place to be in right now. The recent events from COVID-19 pandemic to the war in Ukraine have severely disrupted global trade patterns, obviously, and the UK faces all the same challenges as everyone else. But our underperformance in export sales compared to other economies is explained, according to recent reports from the International Monetary Fund and the World Bank, by Brexit, which is holding back export growth. More recently, the World Bank has also raised concern about lockdown in China and in China's major cities, including its financial, manufacturing and shipping hub of Shanghai. And they expect that could add further to slowdowns in global trade. But the interesting thing to note this quarter is that, at least in the short term, factory shutdowns in China have actually led to a slight increase in demand for UK-made goods from the Far East, as companies there source alternative providers for the input component parts that they need. The other key markets that we typically have from a UK point of view are the EU and the United States, and they remain roughly on trend with what we were expecting for this quarter. So at least there's some positive notes there. Going into a bit more granular detail, the rising cost of doing business is starting to hit manufacturers harder than ever before, and not for the first time in the last few years. Many firms are having to make a lot of difficult decisions right now about how to continue their business, whether to shut down temporarily or how to save on energy costs and other rising costs. In the first quarter of this year, 137,000 British businesses closed. That was a 23% increase from quarter one of the year before, so a direct comparison there. Insolvency firms are now seeing a growing number of UK businesses at risk of going under as the costs that they face are spiraling and COVID loan repayments are coming due. Fortunately, demand overall is remaining high, but access to inputs has made delivering on those orders more challenging. Despite the downward trajectory of the last 3 quarters, manufacturers still expect faster growth in the future. This is something we often see when we survey firms. Individual firms are quite optimistic about their own performance, albeit they might be less optimistic about the sector's overall performance or their rivals' performance, or indeed the overall economy. So this is kind of a typical phenomenon that we see, and for that reason, I think we need to take it with a little pinch of salt, albeit, of course, firms know their own businesses better than most, so maybe they have a right to be optimistic. That said, issues around the war in Ukraine, COVID-19 lockdowns, and perhaps some other unexpected event, we've become very used to having to expect the unexpected and adapt accordingly and be very flexible about this. So who knows where the future difficulties might lie, and I wouldn't necessarily expect things to calm down anytime soon. Given how quickly the economic environment changed between quarter one and quarter two this year, partly off the back of the war in Ukraine and the unexpected increase in COVID cases in key trade partners, key trade countries, it's challenging to accept the optimism, but at the same time, it's still something that I think gives us a little bit of hope for the short term at least. Nevertheless, this is the 5th consecutive record-breaking quarter for input prices. So from rising energy bills to logistics to growing wage demands, increasing difficulties sourcing raw materials, and the highest tax burden in over 70 years. UK manufacturers have seen it all in the last few months, and our latest survey results show prices have continued to expand at record rates for almost 5 quarters. UK price growth has shown some marginal slowdown, reporting a balance of 54%, which is down slightly from 58% last quarter. But it's still the 2nd highest balance in our survey's 30-year history. Export prices continue to speed ahead of reporting a balance of 52%, up from 50% last quarter. And the acceleration of rising export prices has likely also played a role in declining export orders, which saw a more severe slowdown in growth than domestic orders this quarter. According to the Office for National Statistics, input inflation is at about 18.6%, which is the highest in their survey's history, whilst output inflation is rising at a relatively slower 14%, although that is still significant, quite a significant number. It's still quite high. It's the highest, in fact, since the global financial crisis in 2008. So unsurprisingly, manufacturers across the board are reporting continued declines in their profit margins as the cost of doing business rises to unsustainable levels and raises the risk of further insolvencies if businesses end up defaulting on their debts. So that'll be a big worry, particularly for smaller firms that typically have much less capacity for dealing with these sorts of challenges. So as a result, optimism is softening as the performance declines. So this quarter's Manufacturing Outlook Survey report finds that firms' confidence in business conditions remains quite optimistic overall, despite the global challenges. However, the level of optimism has slightly turned towards negative this quarter for certain parts of the UK, which is below those the numbers below the 5 inflection point, the middle horizontal line on the chart that you can see. Unsurprisingly, most areas of the UK have reported a continuation of the downward trend in optimism seen over recent quarters. And it's apparent that both ongoing and novel challenges are beginning to bite manufacturers' operations, and that's making it increasingly difficult to stay positive about their performance for the next 12 months. Still, confidence is a volatile metric and can change dramatically depending on the day-to-day performance of an individual business, as well as the news surrounding the UK economy or politics more broadly. So it doesn't necessarily always correlate to future performance. However, as was the case in the last few quarters, the declines that we're seeing in confidence are mirroring those declines being reported in actual output and orders too. The biggest issues that have impacted confidence levels recently include the cost of living crisis and the escalating cost of doing business. Manufacturers are facing rising costs for raw materials, labor, energy, and freight transport, as well as the highest tax burden in 70 years. Coupled with these costs is the growing difficulties firms are facing in accessing raw materials, labor, and freight transport, even when they are willing to pay higher prices. So in line with the national average, all regions and devolved nations have reported a fall in business confidence compared to last quarter. There isn't, unfortunately, any particular region that sticks out in bucking the trend and being slightly more optimistic or seeing a slightly better performance, unfortunately. Moving on to what this means for employment and investment. Well, Chancellor Rishi Sunak recently warned that the economy faces a perfect storm, and at 9%, UK inflation has not been this high since the Consumer Price Index was invented in 1982. The older retail price index measure is even higher at 11%. The usual remedy is to raise interest rates, which makes it more expensive for consumers and businesses to borrow, meaning they spend less, helping to cool demand and in turn slow the pace of inflation. However, about 4/5 of the current rise in inflation is driven by global energy and food prices, meaning domestic interest rate hikes will likely have little effect. And the Bank of England Governor, Andrew Bailey, has warned that the UK could therefore be on the brink of recession, which is defined as the economy getting smaller for 2 consecutive quarters. Insolvency firms, as I mentioned earlier, are also seeing an increase in the number of firms being classed as at risk as spiraling costs and COVID loan repayments come due at this time of year. The Office for National Statistics revealed earlier this month that the UK economy has shrank last month by 0.3%, and that followed a shrinking the previous month by 0.1%. So that combines with the fact that national insurance hike, myriad other increases, including energy, VAT, council tax, and broadband bills have all kicked in recently. So we're likely to see a continuation of that trend in the months to come as well. However, I don't like to be overly pessimistic. So on a bright note, demand for new homes continues to outstrip supply, despite mounting fears about the overall UK economy, which suggests that for the construction sector, in the medium term at least, there is a likelihood that the housing market will cool rather than crash. Expectations of a slowdown have obviously increased, and the Housing Secretary Michael Gove has taken a hard line with the sector over building safety. So inevitably the housing market is going to moderate, but the data to date suggests that trading has not really abated just yet. Overall, build costs have risen by 6 to 8% this year, but continue to be offset by rising house prices, with a chronic undersupply of new homes in the country, ensuring demand remains quite resilient. More broadly, however, despite the Bank of England's interest rate increases since December, money markets expect more in at least one of the MPC's next 4 decisions, and that will likely help dampen demand in the housing market. Mortgage brokers forecast that increased borrowing costs will almost certainly slow demand for property and in turn cause property price growth to slow. It will dampen enthusiasm, but it won't necessarily cause prices to fall. The pound also continues to perform poorly by historical terms, and that at a time when other currencies are also performing poorly. The euro sank to a 5-year low against the dollar recently, raising expectations that the world's 2 most traded currencies could soon reach parity for the first time since 2002. Parity is an indicator of a lack of faith in the euro area economy, which, despite trade falls since Brexit, remains the UK's biggest export market. So the knock-on effects of this will hit the cost of living here and perhaps further dampen demand going forward. The head of the World Bank has also warned that Russia's invasion of Ukraine is causing risks causing a global recession as food prices, energy, and fertilizer experience the largest commodity price shock seen since the oil crisis in 1973. Around 3/4 of the rise in inflation, the rate at which prices rise, comes from higher electricity and gas bills, according to the Office for National Statistics. Energy prices are set to increase more than 50% this year, pushing bills further up for households and for businesses as well. So not good news if your business is energy intensive. The cost of filling an engine has also risen sharply for businesses and consumers, including freight transport companies as well. The average cost of a litre of petrol has increased by 25% since last September, and for diesel by 30%, according to the RAC. But even if you're trying to be green, which is usually the safe outlet for all of this, the cost of filling a green car, or rather the electricity supply involved, has risen by 21% this year. So right across the board, regardless of the method of transport you use, costs are going up. And that's going to affect both individual workers and staff, and therefore push up or add to the growing demand for wage increases. But it's also going to increase the cost of shipping and freight transport and delivering those goods and receiving them as well. Oil prices are expected to remain elevated well into 2024, and the barrel of the benchmark crude, Brent crude, is projected to average over $100 this year. So there doesn't seem to be any respite on the energy cost front. For manufacturers, higher prices in the UK risk becoming embedded as input costs, including wages, continue to spiral upwards. So we could just be facing the new normal of higher prices and higher costs of doing business. In addition, the war in Ukraine will severely set back the global economic recovery, and the UK will likely be hit harder than most, according to most international observers, particularly the International Monetary Fund, which now expects the UK to be the slowest growing G7 economy next year and the second slowest in the G20, behind only Russia, which of course is facing the unique challenges of global trade sanctions as a result of its invasion of Ukraine. So it's perhaps inevitable that manufacturers' intentions around employment, recruitment, and investment in new technologies have taken a hit. On a positive note, new ONS stats indicate that there are more job vacancies than unemployed people in the UK for the first time since records began. The unemployment rate fell to 3.7% earlier this year, which is the lowest it's been for almost 50 years, and job openings have risen to a new record high of 1.3 million. The data shows there has been a rise in the number of people moving from economic inactivity into work, and also an increase in the number of job-to-job moves post-pandemic. So at the same time, all of these things mean that total employment remains below its pre-pandemic level, because around 500,000 people have left the labour market over the last 2 years, owing partly to an exodus of migrant workers after Brexit, and the new post-Brexit immigration barriers making it more difficult for new migrant workers to come to the UK. Older workers have been retiring at an increasing rate over the last 2 years during the lockdowns, and there has been a rise in long-term illness, specifically and in particular long COVID, which is now or can now legally be classed as a disability, and the implications for that around recruitment and retention could be quite considerable as well for firms. So considering nevertheless, considering the anticipated hit from the pandemic around employment figures, these figures nevertheless remain surprisingly positive, but they don't yet take account of the impact that real wages or the decline in real wages are having, and the likely squeeze that will put on consumers and consumer spending, as well as on workers themselves and the demand for wage rises. So in sum, inflation, higher energy prices, labor shortages, global disruptions to trade are all causing firms to pause investment for the time being and take on a wait and see pattern, stopping them from creating new jobs and paying higher wages. But there's also a risk that further disruptions could make it more difficult for us to come out of this really difficult period. So it's likely that we're going to be facing a very challenging set of circumstances across business for the next 18 months to 2 years or so. Based on that, as I mentioned at the start of the presentation when I was giving the top line figures, we have revised down our forecast for the manufacturing sector as a whole and for the UK economy as a whole this year. So our manufacturing growth output forecast has been revised down for 2022 from 3.1%, which was the previous rate of growth that we expected. We now think it'll be closer to 2.3%. So a 1% decline, which is a significant fall. But in 2023, our forecast remains at about 1.7%. For the UK economy as a whole, however, we have revised down our growth forecast this year from 3.8%. We now expect it to be about 3.6% growth. But next year, we expect a significant decrease in economic growth, now expecting 1.4%. We had been expecting 1.6%. So I'll just move you to the final slide, which is just a reminder of the key points that I've discussed. So orders taking a big hit, both domestically and in terms of export orders. Prices and costs of doing business are escalating rapidly, and as a result, the profit margins for businesses are being squeezed, and that's putting pressure particularly on smaller firms. And the result of all of that is that employment and investment intentions, whether investing in new staff or uptraining and upskilling your workers or adopting new technologies, those plans are being put on ice for the time being as firms try to weather the storm. Most firms are quite optimistic for the future, but overall, we expect both the manufacturing sector as a whole and the UK economy to take a hit this year, but particularly next year. So we're in for a difficult couple of months and perhaps even up to 2 years of difficult economic conditions. I'm going to stop talking at you there and open it up to anybody who wishes to ask me any questions, but thank you for listening.
Thank you very much, Seamus. I heard a précis of this at a Make UK meeting the other day, but I've already picked up more things that I missed. As you say, it doesn't make for particularly happy reading, but there is, I think, a few things that we can be positive about. Just while people are thinking about their questions, I've often talked to manufacturers about reshoring of the supply chain, and that would seem to be more urgent now, given the global political situation, but also the instability and massive price increases of shipping. I mean, I don't know, what are your thoughts on whether there's an opportunity to have more of a domestic supply chain?
Absolutely, there is, and I think it's something lots of firms are looking to do. It's not always possible, but where it is, it can be a huge insulator in terms of protecting firms against the kind of global challenges that we've been facing and the unexpected turbulence that has come from the war in Ukraine, from COVID-19, from whatever else might be coming down the line that we haven't quite anticipated yet. It's always much easier if you have a local relationship with a company based in your own country that you can have a consistent supply from. The difficulty, I think, will be depending on the individual firms, the kind of components that they need. So one of the things that has become a real challenge for lots of firms throughout the industry has been accessing raw materials. And that, unfortunately, is something that can't be done domestically if it is the case that the raw material, for example, a lot of firms in the machine sector rely on specific metals because they have particular properties, heat resistance, lower expansion rates, etc. that these metals can't be sourced in the UK. A lot of them typically come from Russia and Ukraine. So the supply of those metals are causing significant challenges, particularly in the aviation sector around the production of engines, also for batteries. So it really depends on your individual firm, the kind of products that you produce. But where possible, it is a huge advantage if it can be done, and it does insulate you against a lot of the challenges that we're likely to be facing over the coming months.
Yeah, I know Make UK have an offshoot, the UK Steel. I guess that's really having a lot of turbulent times with, losing the steel production from Ukraine, but also on the safeguarding side. Yeah. I don't know. The CEA is interesting because we have both consumers of steel and manufacturers of steel as our members. We've got British Steel and Tata Steel as members. So whether that will have a short-term solution, I don't think it will. But
I think the big challenge for steel right now is it's a very heavy energy-intensive industry, and the increasing costs of energy are just going to be very challenging for that sector. But one of the positive things that we have seen, and it's not necessarily possible for all companies again, but we know from recent surveys that about 60% of manufacturers are looking to produce their own energy. Whether that be installing solar panels on their warehouses or their factory roofs, or looking at other hydroelectric generators, whatever it may be, that might be site appropriate, but where possible that can help mitigate and reduce costs. It's not always, as I said, possible for everybody, but it could potentially be a solution for some.
Yeah, that's interesting. Have we got any questions from the floor? I can see Sean Edwards there. You might have some ideas on supply chain. Everybody's gone very quiet. You've bamboozled people.
No, not bamboozled at all. Just catching my breath because you was right. I was eating my lunch.
Sean, do you want to just introduce yourself and then say something?
Yes. Well, I'm Sean Edwards. I'm the managing director of ATG. ATG are a company that are a global sourcing specialist. We recently marketed ourselves at the Hillhead exhibition. I think it was clear to see with all the lanyards around the neck, everybody was asking the questions, who are ATG? But ultimately, we source products for the manufacturers around the globe, predominantly China. Seamus, I think your presentation was excellent. It was accurate. The issues that China are facing as a whole, you spelled out quite clearly. Yes, there's one thing after another. We joke here, we're just waiting for the volcano. The supply line is been affected by so many issues over the last 18 months. The way ATG have coped with it is actually spreading the risk as much as we can, and that is with the amount of suppliers that we source the product from China and India, and that's just spreading the supply line. But at the end of the day, it's all about the manufacturing. You need suppliers, you need customers, and our customers in the construction manufacturing industry are suffering. We are not helping. At the end of the day, the length of time that product gets from one side of the world to the other went up to a maximum of 14 weeks at one point. That resulted in a lot of the manufacturers air freighting product. And as you can imagine, air freighting product is 25 times more than it is to sea freight it. We were rail freighting it. Thought we'd caught a trick there by rail freighting product. Then the Ukraine war came along, and the train from China to Europe goes straight through Russia and Belarus. So there's always been a hiccup over the supply line. Interesting to hear your comments in regards to forecasting. I would say following the exhibition that we've just done, there's a lot of positivity There's been a lot of purchases of companies, which has resulted in higher forecasts of the products that they're manufacturing. But we're a very cautious group, and I think there's certainly a lot of substance in the forecast that Seamus is actually saying is that the backlog is actually created the feeling that everyone's busy. That backlog has come from the COVID pandemic, but overall, I feel that Q3, yes, Q4 for sure, 22 there will be starting to see a slowdown in orders, and then the expectation of 23 where we'll see a relative reduction in the orders that are being placed with our company. Does that help much?
Yeah, thanks, Sean. It's interesting to get the view, because I picked on you knowing your business model.
Yeah, I mean, if anybody's got any questions to me, you're welcome to put them to me, really.
Have you got any comeback on that, Seamus?
Yeah, I was just, well, first of all, thanks, Sean, and I'm glad to hear that our data matches your experience, albeit not necessarily a positive one. It's also really interesting to hear how you've adapted to the difficulties that the lockdowns in China have placed on your business. I think flexibility is really important in this, but it's not, of course, always possible. I've spoken to some members at Make UK who have inbuilt fixed process clauses in their contract, which means that they're just not able to diversify their supply chain because for someone further up the food chain mandates that they have to source their goods from a particular supplier. And if that supplier isn't able to deliver, they just have to suffer the consequences of that. So that kind of thing, I think, is going to cause a lot of challenges. And I think it's really important at this stage, given the integrated nature of the UK supply chain in particular, and the number of smaller firms that often feed into bigger firms further up the food chain, it's really important for firms to really know where their sources, where their goods come from, and to map their supply chain where possible. The other side of this, of course, is, again, it depends on what your contract clauses are. So have you fixed prices? Were they agreed before all of these economic effects started to take shape, or are you likely to have to renegotiate contracts in the coming months? That will really determine an individual business's response. But it means that there's an awful lot of vulnerability in the supply chain, because while your firm might have done everything right and proper and might be well prepared, you don't necessarily know if your suppliers are. So speaking to your suppliers both up and down the supply chain is going to be a really important thing that we do over the next couple of months.
I'm going to pick on some people now just because I can. Richard Melton, BSP, can just give us an update. I know you were quite active in Russia before the invasion. What are your thoughts on exports at the moment? Is it all a horrible nightmare, or are you actually still managing to get products shipped?
Yeah, we're still holding our head above water, I think. Russia has caused us a problem, and it has lost us some orders. But I think there's some other bright spots. I've actually just come back from the Middle East, doing Dubai and Saudi Arabia, and there's some massive projects out there, especially in Saudi Arabia at the moment. So, but with the sort of Arab mentality that they want it now, not in 6 months' time, and I think that will be our challenge really, is getting our equipment made quickly with the supply chain problems that we currently have to meet that demand. So yeah, I mean, there is some brighter spots. A little bit disappointed to see some of your graphs there, Seamus, with what I've got to look forward to next year. But if that's a reality, we need to sort of batten down the hatches a little bit. But I think there are some bright spots that we can go chasing after.
Yeah, thanks, Richard.
Richard, don't shoot the messenger.
Yeah.
May I, it's Dale Cancel, may I ask a question?
Oh, hi, Dale. Yeah, I was going to pick on you next. So.
Good. I thought
Good,
I'd jump in first, rather than be chucked off the edge of a cliff. Thanks, Seamus. Really interesting information there, very informative. And you actually touched upon in one of your previous answers a matter that is dear to my heart, and that's electrification. Our members, CEA members, sorry, I'm the technical consultant to the CEA, Dale Cancel. So our members are, of course, investing massive sums in the route to net zero, looking at many options. One of the main ones being battery-powered machines, and you already touched there upon the global supply and the disruption in terms of battery production and supply. Of course, earth-moving machinery is still behind the automotive in terms of battery demand. But I was wondering, is the UK government doing anything in order to ensure the surety of supply of batteries for our main producers? If not, maybe should industry be doing something to start already positioning itself to encourage government to be doing something to help in the supply of batteries to our manufacturing base?
That's a really good question. Ensuring that there's a safe and consistent supply of batteries, industrial batteries, has been something that this government has talked a lot about, and particularly pre-pandemic. It was a priority that Boris set out. He wanted us to become a world leader in battery production for industry. Unfortunately, recent events mean that a lot of those plans have been put on ice, and there hasn't really been much action from government in recent years about advancing them. But I know that it is a longer term project that will continue, and there's lots of civil servants looking at how they can facilitate it. But I mean, in terms of the immediate and shorter term, it is going to have to be up to industry, unfortunately. There's a lot of skepticism from experts about whether the UK will be able to produce batteries on the level that our economy needs. So we are always likely to be reliant on supplies from elsewhere, not least because, as I mentioned during the presentation, some of the component parts, particularly around rare earth metals, just aren't available in the UK. We don't have them here. Those resources need to be sourced from elsewhere. So it's going to be a big challenge. But I think when we speak to the Chancellor and when we speak to civil servants at the Treasury, there are a lot of ongoing discussions about what kind of incentives can be brought in, whether it be in the budget or by other means. You know, we talk about super deductions, we talk about tax credits, etc. So there is an awful lot of thinking going on at the moment, and those conversations have just restarted now because the government are facing up to the reality that we are going to be going through a very difficult economic period for the foreseeable, and the effects that that's going to have on the cost of living is going to affect everybody in the country. So they want to make sure that businesses are able to stay operational, keep people in employment, keep the economy going, because ultimately they need that, and we all do. So I think there's clearly an appetite within the civil service and within cabinet for good ideas. These things just take time. So in the meantime, it will have to be up to the individual businesses themselves.
If you're talking to Treasury about super deductions, we're having an ongoing battle with them, with us and Construction Plant Hire Association, is that you can't get the super deduction on construction equipment if it's hired out without an operator. And there's a massive, I think it's about 60-70% of UK output of construction equipment goes into the rental market. And to make it even more galling, the Chancellor used construction in his first budget speech as an exemplar, and also a recent promotion used a picture of a big excavator, and you think, well, hang on, mate. We've sat down with your officials and explained that it doesn't work and we want an exemption. But so perhaps you could just pass that one on. Sorry, Dale, I jumped in there.
No, thank you, Seamus. Excellent answer. It's exactly as I thought. Market forces, unfortunately, will have to prevail in the short term. But certainly, I think we ought to bear in mind, the back of our minds, maybe for when things do start to settle down a bit, hopefully, which will be sooner rather than later for all sorts of reasons. Yeah, how do we ensure we get our hands on the batteries that we desperately need, because we're all keen to go down this decarbonisation path, but obviously we need the materials in order to do so.
Absolutely. If I can come back, Joanna, on your point around the super deduction, yeah, we're very aware that it's a good policy, and I think across the board most manufacturers recognise that and appreciate it. It came in at a bad time, so it wasn't necessarily used as much as I think firms would have liked, or indeed the government. There are some tweaks that need to be made, but it's certainly something that the Treasury are keen or are interested in considering reforming and perhaps re-implementing. I think another aspect of this, of course, is that we want surety and certainty around policy support from government. So it's not much use bringing in a policy like a super deduction if it's only done for a year or for 6 months, or whatever it may be. business investment is a long-term decision. It often takes years to make a significant investment decision in a firm. So we're speaking to government about what can be done in the longer term to make sure that there is that kind of environment set so that we can invest in creating new batteries or other aspects that are going to be really important going forward across the board.
That's great. Thank you. Has anybody else got any comments or questions? Speak now or further hold your peace. Just before we wrap up, Seamus, I don't know whether you wanted to say anything about the Make UK Manufacturing Day on the 7th of July.
Just to say, get involved if you're not already involved. It's always a great day. It's a really important day for the industry in terms of helping to get new talent in, attract young people, change the image that we have, because I think, as many of you I'm sure will know, a lot of people who are not involved in our sector have a very outdated view of what manufacturing is and the kinds of things that we do. And of course, our industry is disproportionately high skill, high wage. The average manufacturing salary is about 12% above the national average. So it's a really good industry to be involved in. It's exciting, it's innovative, we do fantastic things. So I would encourage you to get involved if you're not already, and to enjoy the day.
Brilliant. Okay. Well, that's been really informative. As I say, really informative and slightly worrying, but not as worrying as I've seen it in the past. We don't seem to be in 2008-9 territory yet.
That's it. We've been through a lot in the past. We'll come through this one as well.
Yeah, no, that's great. So I'm just quickly going to share my screen again and find the button. Just to say that, there we go. You will be able to hear from Dale again at the next Power Hour, which is the 21st of July. And Dale's going to be having a canter through the first 6 months of regulatory changes affecting our sector. And that will be followed up by the CEA's AGM. Hopefully you will all have got an invitation to that if you're a CEA member. Finally, Plantworks sales are now open. We sold quite a few stands at Hill Head last week, including some of the big anchor sites with the dig zones. So if you haven't already been contacted, you should be getting emails quite soon about booking your stand at Plantworks back at Peterborough again. So even when we get the inevitable Plantworks rain, it does have hard standing and footpaths. Well, that's all, folks. And thank you very much for attending. And thanks again to Seamus and everybody who made a contribution. See you next month.
Thank you, Joanne. Thanks,